from the MITM Business Consultants.
Comes Man in the Middle, your one-stop shop for financial tips and tricks that big banks and corporate America won't teach you
And don't want you to know.
discussing the latest and greatest products, services, skills, and habits to grow and support the financial needs of your business and you. Giving you the knowledge to help make your own important choices for your business and you.
Disclaimer. Man in the Middle expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use this podcast or the information presented in this podcast.
Now, here is your Man in the Middle with 10 years of experience in the financial and banking industry, Art Abrahamian.
What is going on, everybody? Episode 17, Man in the Middle. Payson, what's going on?
It's our anniversary today.
It's our 10th episode of Payson and I doing the podcast, and I'm sure you guys have noticed I was gone for a couple weeks.
Yeah.
Not because I wanted to be. I had pneumonia, and boy, did that suck.
It was bad. I saw it firsthand.
So,
And I heard it firsthand.
Yeah, it
didn't sound too good.
It was rough, and we were just, man, I don't even have words for it. It was so bad. In and out of the hospital nonstop for like 3 weeks because just lack of proper diagnosing and wrong, doctors not giving a damn about anything. So it was a mess, man. It was a mess, but I'm glad to be back. It just was like I've only been back for like a week, but I spent that week trying to catch up of almost 4 weeks of nothing. But nonetheless, we are back. We're happy to be here. We missed it. I missed it. I know Payson is. We've been talking about doing it for the last almost month. So before we get started, I want to thank the sponsor of this channel. See, I got to get back into it. It's been a while. USCCA. And if you want to know more about USCCA, go ahead and hit that link in the description below. And before we get started, we're going to go ahead and play the video.
It's in our nature to protect the ones we love, to stand up to any danger, to be strong and courageous, to always be prepared, to keep our family safe, to be the first line of defense. We are born to protect.
I miss that.
Back to the chills.
That's what those chill. I miss those chills, dude. It's been a couple weeks. What's funny is some of our members have said they're like, you could tell you were going downhill because I guess I was progressively coughing more and more in the podcast. So I was like, I didn't even.
You could go back, watch all the videos, and you could see it as it progressively.
My cough was getting worse and worse and worse. Yeah, today's episode, and you had brought up what was going on in the current real estate market, and I said, you know what, I think it's a really important topic, and I think it's something we should cover. So I'm actually going to give the lead to Payson today to just share about what's been going on with the current state of the real estate market and what's changing and some do's and don'ts, and I'll chime in with my professionalism as well, but Payson, well, I've been sick for 4 weeks. A lot has changed, and who better than from the mortgage phenom himself, the guy selling houses like they're hotcakes. So tell us, dude, what's going on? I mean, what did I miss in the last 3 weeks of reality? Oh, Sophia, I am sorry. I have the toy.
I was looking for it.
The toy's in the car, dude. I've been so scatterbrained. The toy's in the car. Next episode, there's two toys.
Yeah, we'll have two.
Two toys. So, hi, Sophia. I'm sorry, baby. Pretend there's a toy here, but next week there'll be two. So, anyways, tell us about the current. What's been going on since I've been gone?
Well, interest rates are going up again.
Where are they now?
They're sitting around in the mid sixes, sometimes in the low sevens.
Sure.
But Jerome Powell just came out this week and said that they're going to bump them up, I think, at least another half a point. if not a little more, even more than that. So it doesn't seem to be doing where interest rates are at now. It doesn't seem like it's doing what he wants it to do for the current real estate market.
And who's he?
The chairman of the Fed. So he's the one that dictates what
that's right.
interest rates are going to be. So
The private company that dictates the world's interest rates. That's right. They're not even a government entity. You know that, right? They're a private company that determines all that. The call them the feds, but they're not even.
yeah, they're not the Feds.
They're not the feds. It's really funny. 7%, 6.5%, 7%. I want to address this because I've been hearing this a lot. Like, whether it's on YouTube, whether it's from phone calls, because although I was out of the office for that long, I was still getting phone calls here and there. And this 2-3% stuff, people have got to understand
It was
that's
like a once in a
it was
lifetime.
a once in a decade type of thing. These rates, I think the problem is people just got too used to those rates.
Yes,
And
I
now
think that's 100% what it is.
Rates are going back to what they've historically always sat at for decades.
Right.
Like these were the norm rates, and then we got spoiled with like sub 3s and low 2s and mid 2s, where it's like, hey, we're not going to get that again. I think the biggest concern, in my opinion, and you tell me what you think, is like when interest rates are down, pricing goes up. When pricing goes down, interest rate goes up. The problem is we're having interest rates go up, but pricing's not really budging.
No, because there's still more demand than there is actual supply.
Right. And that for me, like with my expertise in finances and everything, is where I start to kind of go like, it sucks because this younger generation, which we are, owning a house is the goalpost is being pushed further and further.
That's what I've heard stuff saying we're going to be like probably the last generation that's going to like where the majority could even possibly own a house.
Yeah.
Like it's going to be mostly like everyone hereafter, like kids growing up right now are just probably going to be renters.
That's
unless
what
they're
Gen
making it.
Z and Y and all those peoples.
Yeah, I think everything after Gen Z is supposed to basically like, hey, you're pretty much set to be a renter unless you're someone that's making more than a whole lot of money probably.
Right.
Because I mean, think about it out here now in the Coachella Valley, for the lowest homes I'm seeing, if you want to be in certain areas, is $450,000 to $500,000.
That's wild.
And that mortgage is going to be well over $3,000 a month.
Yeah.
So that means
But it's like you made this point earlier. It's like, but that's the thing is, even if they try to go rent, they're not renting for any cheaper than owning would be.
No. So it's like that's where it's like it's right now it still makes sense to buy if you can, but obviously it's just the interest rates they're expensive compared to what they were a year and a half ago or two, and I think that's where the shock is.
Yeah.
Because we're sitting at about as many transactions as what we were back in 2009, according to stats right now.
Of home sales? Mm-hmm. Okay.
So, but we're not seeing any more of a price decrease. We saw about a 10 to 15% price decrease over like the past 6 months to 12 months, but we're not seeing it anymore. Actually, in some cases, we've seen an uptick in some houses where they are going in a few days over asking if they're priced right. So it's still happening. It's just not happening, obviously, how it was with every single house for the last 2 years beforehand.
Right. I was reading a statistic that stated like people in their 30s are now moving back into their parents' houses, like in droves.
That's crazy.
In droves, like the statistic was pretty wild. And while you talk, I'll pull up that statistic to see what it was. But it's like the dynamic shifted, where it's like, and I'm sure, and I probably said this before, I am sure the young people listening get a bunch of crap from their grandparents or parents. Like when I was your age,
I bought my house at 18 years old.
I had a family and a house and a car, and we were on vacation. And it's like, the reality is when you were my age, the wages still are the same from when you were my age, and statistically speaking, I believe that a average family could live off of $50,000 a year, and that was considered like a good income. And that was just the husband working, the wife taking care of the kids, house, car, vacation, toys, Christmas, you name it. And it's like, inflation at the rate that it's going, it's like people keep thinking, and I've said this, people keep thinking it's a wage issue. It's not a wage issue. It's an inflation issue. Like 2.3% is supposed to be the standard of an annual increase, and it's like 8.9% total annually. And then on month over month, it's like 6%, 8%, 7%, 10%. We are just demolishing every industry that keeps inflation down. And I'm not even trying to be a conspiracy theorist. I just can't tell if it's like on purpose anymore. These are like blatantly stupid decisions being made by older people in government who have been there for way too long. All of them. I don't care what side of the aisle it is. All of them just being there way too freaking long. And they are ruining the economy and the markets for the younger generation. And, you hear that a lot where it's like the baby boomers ruined everything for the next generations to come because of their decisions and their overspending and underspending. The debt ceiling just keeps going up and up and up.
Insane.
It's like, how do you maintain this chaos? It just doesn't seem reasonable. And it's like now people can barely afford to find a place to rent. They can barely afford their groceries. They can barely afford anything, and it's sad.
Like the cheapest places out here at this point, it's like $1,500 a month,
and that's nothing.
It's nothing.
I mean, the place, not the amount.
Yeah.
The place you get for it is nothing. And it's like this. I have friends, a lot of friends in Orange County, and it's like.
Yeah, that's even more insane.
It's even more insane. And you have people in droves moving. And it's like, I can't tell if it's any better or any worse. And it's like, it's just one of those things where it's like, how do you keep up? It's impossible. It's impossible to keep up.
Like, I remember, it wasn't even that long ago, but 10 years ago, my parents bought a house for $225,000, and it was a 2,800 square foot house on a 15,000 square foot lot with stainless steel appliances, granite countertops, all this stuff. That same house now is selling for $500,000 to $600,000.
And it's not
going
to
10 years.
People keep, I'll just wait for the real estate market to crash, so I'll buy a house at 200. I'm like, I don't think you're ever going to see those prices again.
No.
I think the dollar's not worth what it is.
Right. I think we already hit like that where it was going to go down to. We've already dropped in some cases 15%. I don't think it's going to keep going more because people still need a place to live. Yeah. That's the problem. So like I personally feel like if interest rates came down a little bit just so that way it's more affordable, I don't think it should go back to the 2-3% because then we're just going to go back to this mass hysteria, but maybe at that like 5% instead of where we're seeing like I've had some people get quoted on some stuff and it's like well over 7%. And it's just like, wow.
Well, I mean, you can get to 5% with a rate buy down, but it's not real. You're paying for a better rate.
You're paying a lot. So, like, in some cases, we've been able, like, I have one deal going on right now where we were able to get them, I think, down a whole point. I think they were at like 5.99, and we have them at like 4.99, which is awesome.
Yeah.
But it cost we got a seller concession, so a seller credit. The seller's paying towards the rate buy down for them, and it cost a total between we got closing costs covered for them too, but it was about $23,000 that the sellers credited for us, and 2% of that or half of that went towards the rate buy down. So it was like a $12,000 rate buy down to get down a point. So it's not cheap.
That's crazy.
Most people can't afford that. If you're a home buyer, you could if you find the right agent, you find the right home, you could get a rate buy down potentially from the seller and save yourself some money, but most people don't have an extra $10,000 to $12,000. They're already scraping together that $10,000 to $12,000 just for the down payment.
Yeah, I found the statistic about the moving in. So, 25% of millennials, 1 in 4, are living with their parents. And by the way, millennial, I know it sounds like young people, but that's us, and that's the age range between 26 and 41. So if you're in between the age range of 26 and 41, we are considered millennials. And 1 in 4. Oh, you're not a millennial.
No,
you're
Gen Z.
You're Gen Z. Oh shit. I'm the millennial. Okay. 1 in 4 millennials are currently living with their parents. This is the one that I was talking about. 1 in 8 have already moved back with their parents.
So crazy. It's so expensive now. It makes sense. Like just like we're talking about, like if you want a 3-bedroom house right now out here in the desert, you're pretty much spending at least $3,000 a month to rent.
Here's 58%. This is not just millennials. More than 58% of young adults in the U.S. are living with their parents.
Yeah, that doesn't surprise me.
And this is, so young adults are categorized as those 18 to 24. So 58%, the 18 to 20,
That makes more sense.
that makes sense. But like the 22s to 24s, they're about, so take that all into consideration. You have 58% between 18 and 24. But again, we're talking about the scenario of grandpa telling us, when I was your age at 18, I had a wife, I had a kid, I had this, I had that, I had this. It's just not feasible anymore. And it's,
No.
what? I feel for those who have to hear that conversation all the time, because it's different, and yeah, well, grandpa back in the day, you made 50 grand and that kept all that up. You bought your house for $50,000. And the rates then were crazy, though. The rates then were like 15, 17%. But I'll
Right.
tell you this any day. I would take a $50,000 house for 20% all day, every day. That's like a car payment with bad credit. You know what I mean? And you have the state of everybody's credit. When I was working at the bank, the national average was 630 was the consumer credit score for the national average of everybody in the U.S. 630 is considered very poor. I need to know, I want to know now, current credit score of U.S., like combined, just to see what it is. And it's gone up. So the average FICO score in the U.S. was 714 in 2022. So people are doing better with their credit, which is great. And I'm seeing some here that say 710. The range, it looks like, based on what Experian's reporting, is most Americans have a score between 600 and 750. Now, here's actually the breakdown. The average credit score by age. So baby boomers, 740. Generation millennials, 686. Gen X, 705. Gen Z, 679. So it's an interesting teeter of like the credit. It's funny, baby boomers 740. It's because stuff wasn't that expensive. People could afford their debts. And, I think at that time, too, if we really did think about it, when they were going to school, they were learning like life lessons. They were in accounting classes. They were in cooking. They were in
they had, like,
shop,
auto body, yeah.
auto body. That's why they know how to do all this stuff. It's like, I think the biggest issue.
We had art.
Yeah.
that was our main. That was pretty much our art and theater and band were like pretty much our only.
It's
electives.
great, man. But playing. I mean, who knows? If you're lucky, playing that instrument will get you into a house. But it's sad. It's like I feel like we're just not teaching people what they need to know.
No, I don't think so.
And it's like, look, so my algebra teacher back in high school, I tried as hard as I possibly could. I mean, when I say I genuinely tried. Algebra is not my thing. I am a whiz at geometry, but algebra, no chance. You tell me when X and Y show up, I'm like, I'm out. That's just what it is. They're like a bad girlfriend to me. I don't want to deal with it. I end up passing this class for reasons I'll tell you off camera. It doesn't matter. So I passed this class, and, I was really frustrated one day, and I said, I'll never use this crap in my life. She said, you'll always, we'll see when you grow up. Fast forward, I'm 550 clients deep. They're worth about $600 million. I'm over here doing $1 million loans and pushing credit products here and there and doing refinancing, this and this and that. I went to an event at the casino. The casino had a bunch of like entrepreneurs and a bunch of professionals come in, and the bank sent me to go. Well, guess who's there? My old counselor and my math teacher. And I stand up and I'm talking. They don't even recognize me until I point it out. I'm like, I was talking to one of the students, and I said, look, at the forum, and I said, look, life's interesting. I mean, 1 minute you're up there, and then next minute you're down here looking at your old counselor and your algebra teacher. And they all freaked out, like, oh my God, Arthur, it's been so long, blah, 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 blah. And the greatest feeling that I got was I looked at her and I said, hey, She goes, yeah. I just want to tell you something. What is it? I have never used algebra since I've been in your class, and I am a financial, I am a senior relationship manager. Never touched your X's and Y's since the day I've been in your class. She wasn't happy about that one. She thought that really turned her face sour after I said it, but it felt so good to just be like heart to heart. She didn't expect it, and I'm like, hey, I've never used it once. I just want you to know that. Told you it was stupid. Like, if you're an engineer, go for it. But
Yeah.
I would have much rather have learned Credit 101.
Mm-hmm.
And when the bank had sent me to be the financial literacy educator at one point, that was the best thing. That's actually what made me decide that when I retire, I'm going to go teach this stuff, because whether it was teaching kids how to save, or whether it was teaching college students like the next step for doing things financially, master's program. Like, I was in a master's program talking to some of the most educated people, you bright students, and then you talk to them about like finances and credit and checks and how balancing works, and they're like the dumbest people you've ever met. You're like, wait a second, what happened? It's just they don't teach it. They don't understand it. It's a foreign concept that like we've deviated from. So it's like, when you add what's going on in the real estate market, when you add what's going on in the economy, when you add what's going on in everything all considered, and then on top of that, you're putting uneducated uneducated, not that they're dumb, uneducated in the area of finances out in the streets. They don't understand these things. They can't correlate them to understand what's a good deal, what's not a good deal. I hear about my clients' kids getting their first car at like 17%, paying $500 for a Kia. That's supposed to only be $150. You know what I mean? And it's just like, it's scary. It's scary. And then on top of that, you have like this mass exodus of people who don't want to work because they're tired of being treated badly at work. And to their point, that's fair, but this real estate market, like you mentioned, it's like, I don't know if it's going to get any better. And if it does get better, I mean, what is then that age that we can finally buy a house? 40?
Yeah.
50?
Seems
60?
like it right now.
Like, how many, out of all the people you deal with on a daily basis, how many of them are young buyers? I guess is my question. Let's put it that way.
What's considered young?
Under
Like,
30.
Not like probably less than 10% of them.
How many houses you sell like a year? Ballpark.
Around 20.
Okay. And out of those 20, how many are under 30?
Like 2.
10%.
Yeah.
And what would you say that the average age range?
50s.
Okay. Already have a lot of money.
Yeah. Like they're most of those people are buying second houses typically.
Okay. Why?
Probably because they actually had the financial education.
Well, no, it's not just that, but I'm saying, like, have you come across young potential buyers? Because I'm sure that you get calls. We're not. That's what you've sold, but that's not what you've potentially.
Most of my calls aren't young people. I was just telling you before this. I'd like to find more young people to help them get into houses. I think it's something that if you can afford it, you should do it, because rent costs just as much, and it's better to obviously not throw your money away if you can't afford it. But I don't get a lot of calls for it. I really don't. And I think it's interesting. Like, I've only worked with very, very few of my clientele have been under the age of 30. Like, most of them, and the guys that or the people that I have dealt with, they're like 29. Like, they're like right on the cusp of 30.
Yeah. It's interesting, man. It's interesting to think. Are you not getting called because they don't qualify? Are you not getting calls because they're timid, they're scared? I can tell you that a lot of people don't know they even have the capability to own.
I think a lot of people don't know that they're capable of it.
Yeah, that's what I was just saying. That I don't think
they
they understand that they're actually,
right,
instead of paying $2,000 a month in rent in Tennessee, they could afford to.
Well, and I think a lot of people think that you have to put this crazy amount of money down. And in all reality, in most cases, you could do 3.5% down, which isn't anything crazy. I mean, I know obviously as home prices go up, that number is going to increase. But a lot of people don't know that you could do 3.5% down. People think that you have to have this perfect 800 credit score. So then people are like, oh, well, I'm trying to get my credit up. And it's like, well, what's your credit at? They're like, Credit Karma's saying 750. No, you have a good credit score. Like, you could buy.
I'm going to just read a statistic for you. So this was one that I remember back in the day being told, and it said nearly half of U.S. adults have less savings or no savings compared to, and this is year over year that this keeps happening. And if I remember the statistic, 42, here we go. It's not funny. It's just I thought it was more than that. 42% of Americans have less than $1,000 in a savings account.
That doesn't surprise me.
42%.
A lot of times that's also the issue with the people I have talked with that are younger. They could qualify, but they don't have the money for the down payment and closing costs.
Yeah.
And I could help them get the closing costs covered, but I can't help them cover down payment.
Yeah, and you know, a lot of the times too, it's like some of the things that I've run across is you have these young people who have these 401k plans that they could dive into with their employer, and some employers don't. Because the most common way to do it, and the way that I did it when I first bought a house, was I took a loan against my 401k, paid myself the interest back, but I had been working there for like 5-6 years, so I'd been contributing 6% because the company would match my 6%. And, you know, a lot of people, they see a retirement potential account and they just say, I don't want to put in 6% of that away because I'll just save it, you know. And it's funny because it's like I had a coworker, and she's actually in the process of buying a house now. But that's because after she left the bank, she worked for somewhere and she moved up the ladder. I think she's making almost 6 figures. And she's watching this, you know, she knows who she is. And, you know, I've always wanted nothing but good things for her and her family. They have a great family. Husband's awesome. Kids are great. She's funny. And like we worked together for many, many years. And she's finally in a position, I think she's like 34 now, 33, between 33 and 35, where she's finally in a position to finally get a house. But it's like, I'll never forget. This girl, we used to be like, do you know what a savings account is? And she's like, I don't need to. Opens her purse, and there's literally just money envelopes. She's like, these are my savings accounts. Just cash envelopes everywhere. And I was like, so I was like, what? And she's like, I can't have it in an account.
Like, just under my mattress.
She's like, I can't have it in my account. If I have it in my account, I'll spend it. But if I have it in these stupid envelopes, I won't spend it. And it's like, we used to just harp on her all the time because it was like, we're like, you have to be selling drugs. And the reason we were saying that is like she had $1,000 car payment and this and that. And we're like, what the hell is going on? Like, you are selling drugs or something. It has to be. And if you are, can we get in on some of this action? Because we want some money too. But you know, it's interesting, man. I don't know. It's like I'm dealing with clients now where it's like the process is so different. Where it's like, even if you make $13,000-$15,000 a month, there's still, what the heck is flying around?
It's
Is
a
that what you're
gnat.
trying to get?
I was trying to grab it.
There's a gnat in the office. We're just being attacked. There's not even any food in here. And anyways, it's like these people are already older, and it's like they're just trying to get into their first home or second home because of whatever's going on, you know, whether they're in the middle of a divorce or trying to get a new place. And it's like the process is so different now where it's like, now these people who make like $15,000 a month gross don't qualify because their net earnings for their business as they report it, they don't make as much as 13 a month in net earnings. So it's like, what do you do? I've been seeing a lot of these like stupid scams on TikTok and YouTube that says like, go get a loan from a bank and then start paying yourself payroll with that loan so that you can produce W-2s. And
I haven't seen that. Wow.
Yeah, that's this big thing going on. It's wild. And I'm sitting there going, so you took $60,000 out. Let's say you paid yourself payroll wages. You're paying employer taxes. You're paying worker, you know, and if you're paying yourself, you don't have to do workers' comp. But when you pay yourself a W-2, even if you own the company and you pay yourself wages, you as an employee pay taxes, right? You have your state and federal taxes. Well, then you as the employer have to match the federal employer taxes. So you're paying 2 sets of federal taxes, 1 set of state taxes. So you're paying yourself and you're getting much less than what you actually are giving yourself.
On money that's not yours.
On money that's not yours, that's being borrowed at a high interest rate. And I'm sitting there going, okay, now you've game the system fraudulently to get yourself this house that you can't afford anyways.
Yeah, because now you have to pay back that high interest loan.
So you're paying back a high interest mortgage. You've lost money that you've paid in federal wages or all these taxes that you've paid on the initial sum that you've had. And then on top of that, you owe this bank 60 grand plus 20% interest. And it's like,
Yikes.
your brother actually was here the other day, and he was like, hey, I wanted to ask you a question. I said, sure. He's like, I was watching something, and this guy's older, and he said that he built his business and he built his money by going from bank to bank, borrowing money up to $5 million, and then he used that money. And I was like, and when was this? You said it was like 2001. I was like, okay, that's why. That stuff doesn't happen now. It's like when you have an outstanding debt or a loan that's out, you owe So let's put it in this retrospect. If I pull 100 grand and in a loan, not a line of credit, we're talking about a loan. A loan works like this. You borrow 100,000, the bank gives you the 100,000 and your payment starts immediately, right? The next month you owe that first payment. If I give you 100,000 of 100,000, how much in debt are you? 100%. You have a utilization, a credit utilization on that one product of 100%. Anything over 30% utilization is a negative impact on your credit. So, even as a risk factor, you can't have too much available credit either. So, we'll get to that in a second, but I want to hammer home. So now I get 100,000 from, let's say, US Bank. Then I go to Wells Fargo, and I go, Wells Fargo, I want another 100,000. You think they're not going to see that I just pulled 100,000 at a US Bank? Of course they're going to see it. When I run my credit, they're going to see a new credit inquiry and a new line, a new line of credit or credit impact that's put on my thing. If you're like, oh, if I do it the next day, they won't see it. No, they will see it. That's not how that works. It's all a unified system. So then, okay, let's say we get past the first one, we go to the second one. Okay, let's say Wells Fargo gives us that. And then we go to Bank of America. How many banks am I going to have to go to for them to give me this money? And the reality is they don't leverage that much money if there's too much risk. Now, I'm going to give you a scenario that really happened to me. I went to the bank that I was working at, and I wanted a line of credit, okay? I'm going to put this in retrospect for you because I printed out everything because I was fighting with the internal departments that approve it. I was trying to get it overturned from an internal level because it didn't make sense. It was a bullshit cause. I'm going to say it as it is. I had 2% debt to income, 2%. My credit was a 790. I had over $110,000 in available credit. All I asked for was a $25,000 revolving line of credit because sometimes I wanted to use the bank's cash revolving that I didn't want to use mine to make some quick money on a quick investment or whatever. I got declined. And the reasons that it gave me, the computer was giving me high usage, debt to income, this and that. And I'm sitting here going, what the hell are you talking about? Here's my report from all three bureaus. Here's an accumulative report. And I give it to, he's retired now, but he was the head of the credit department. And I give it to him and I go, okay, what's going on? And he goes, I don't know, let me see. Here's everything, 2% usage, blah, 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 available credit. Then I finally get somebody who goes, listen, the reason that we can't approve it is not because we don't want to. It's because it's a liability if we approve it. You have so much available credit that if we were to give you more available credit, you could decide that tomorrow you want to cash out on everybody and file bankruptcy. So I go, you're making a decision because I have too much available credit. And you don't want to leverage that because it's a risk to your bank if you give me additional credit that I'm not using. Yeah. That's the logic behind the lending system. So when people sit here and go, yeah, just go borrow $5 million from 10 different banks and you can buy that. It's like, you're full of crap.
Yeah.
Doesn't happen. No. Fine, give me that bank. I want that bank's number. I want that bank. But like, if I can't get approved at 2% debt to income, 117,007, whatever, it was a ridiculous number. It's like, I don't use the credit, but I don't want it in loans and credit cards. I wanted a revolving line. And they're sitting here going, yeah, sorry. You have so much available credit that if we gave you this, you might screw us too if you decided to flip the switch. Like, so I do everything the right way. I pay all my bills on time. I have a really high credit score. I keep my utilization down. And I'm still not getting the product.
Yeah, you're doing everything right and you're still not getting it.
It's like, so where do you win on this? Where's the win? You don't win. It's not designed for you to win. I tell this to my clients if they're listening right now. The system's not designed for us to win.
No.
So then what are you left with? High interest private loans. I told you about that private loan that's going on right now, that 4.5 million construction that they're trying to sell for like $6 million in LA.
Yes.
So the story behind that one, guys, there's a group of investors, like 20 guys, 15 to 20 guys. They all got together and pooled their money because they wanted to do this huge construction project. This is out in like the Sherman Oaks area. No bank would give that to them because they all had bad credit. So they found a private lender. Private lenders, these hard money guys, what they do is these loans where it's like, you better hope to God you pay this thing off fast because not only do you owe a lot of interest, but they take the stuff from you. So they bought this lot. They built on it. It cost them around $3 million in building cost. It's a gorgeous place. It's like, what was it, 8,000 square feet in Sherman Oaks or whatever.
That's what you said, yeah.
And they think, okay, well, we'll put it on the market. It'll sell quick. Well, I'll make a couple $100,000, break it down. This is like a $2 million, $3 million profit. Well, the balloon was coming due on that payment. And they tried to refinance it into a home loan. Nobody was giving them a home loan for it. They didn't qualify. It was too much money. The appraisal came in. The official appraisal came in at like $4.5 million. It's on market for $6.5. $2 million over asking, like $2 million over what the appraisal came in at. And if they don't refinance this thing within a month, they're going to lose everything. They're going to lose that brand new construction. They're going to lose it all. And I get a phone call and they're like, hey, can you help us out? We're trying to find this loan. And then it's like, dude, I'm sorry. You guys are going to probably lose that place. And then I called. I felt so bad because it was like one guy managed to finesse 10 other guys to put in their life savings to try to make something happen. And it's like, these things aren't normal. And it's like, I just wish people had more of a mind and acumen around how finances work. And it's not their fault. They don't get taught this stuff, but it's like, again, what happens? They did it. Then they came to me. It's like, what are you coming to me now for?
Yeah.
You already did it. There's your grave is
come
dug out.
beforehand.
Yeah. Your grave's already dug out, dude. It's either, so fortunately they were able to get the company to refinance the debt that they already have. So they put it in another balloon, but now they're paying double the interest, but they're just trying to buy time.
Yeah,
because it's either you're damned if you do, damned if you don't. So this company is going to continue to let them pay a ridiculous rate on this property, and at some point they know they're not going to be able to sell it for what it's being asked. But they called back and they're like, "Hey, all we need to get this to go through is an insurance on it. As long as we can get a policy that says that this thing is covered up to the dollar amount that it's been appraised for." So I start calling around. And now the insurance companies are struggling to write policies because it's too risky, especially in that area. So I calling insurance company after insurance company after insurance company. They're like, yeah, we only go up to 2 million. Oh, we only go up to $1.5 million. I called one of the biggest insurance companies in the United States and they're like, sorry. Yeah, we don't want that one. Eventually they ended up getting one and they got one that was so expensive, but they're like, what do we do? I said, I don't know what to tell you. You guys have screwed the pooch so bad on this one where it's like, I can't even physically help you with this anymore. There's nothing I can do to pull you out of this. Like, you guys are just going to take one bad deal after another bad deal after another bad deal. And you better pray to whoever you pray to try to get it sold. But I don't think there's a reasonable human being out there who, when the appraisal gets ordered
at
4.5, they're still going to pay $2 million over asking. Like, it's just not, or they're going to pay $2 million over appraisal on what's asking.
It sadly sounds like they didn't do their homework too well either on what homes are selling for in that area.
Well, you're doing a lot of bigger stuff in San Diego now, right?
Yeah.
How's that going? Like, how's that market? I've heard that market's great.
Yeah, they're selling easy. You could sell, like in Del Mar, they're selling less than 30 days, up to 10, 15 million.
I wonder why that is. Why is that? Is it just because...
I think people just still are wanting to move towards San Diego. They just like the weather. They like the feeling of it. It's a lot of people that have the same type of money that people have in LA, but they don't like the LA crowd or the traffic and everything that comes with LA. It's a
probably-
lot calmer.
Well, it's probably because the homelessness thing is worse in LA than it is in San Diego too.
Yeah, because it's like, and San Diego, it's obviously it's getting bad, but it's like the where you see it the most is in like downtown, and most of these people aren't buying in downtown. They're buying in La Jolla or Del Mar or Rancho Santa Fe. They're buying in places like that.
Man, those La Jolla homes are like $40-50 million. Some I've been inside a
Some,
few.
yeah.
They are gorgeous. It's a lot of I've noticed a lot of Arab buyers in La Jolla too. It's interesting.
Yeah,
I've if I remember correctly, I was with one of my clients who had a home there, and then I was like, "Who are your neighbors?" And they're like, "Oh, they're like oil tycoons and Emirates. They're Emirates from like Saudi Arabia, who are like millionaire dudes." And they they just come down once a year. This is not even their main home. They have plenty of homes all over the U.S. It's crazy, but it's like, are homes here in the Coachella Valley selling at that price or no, or is that kind of slowed down?
No, we still have stuff selling, but like. There, like San Diego stuff stuff will sell pretty quickly, like up to like 10 million, I would say. Like, well, pretty quickly. Like it could sell in 30, 60 days. Like our similar type of thing would be like your 2 to 3 million. Like that's what but we don't have stuff that's trading over 7 to 10 million on a regular basis. It's rare. Like my friend just sold one out here for I think 7.8 million, but it was on the market I think for well over a year. Like it just doesn't. Those big purchases don't happen as much out here. And it's happening more because there's places like the Madison Club, and there's homes listed in the Madison Club for up to 50 million or close to. I think there's one for 44.
50 million at the Madison.
Yeah. But people are paying stuff like that. I mean, like there's one in Bighorn last year that sold for 45 million. It was listed at 48. It sold at 45, I think, within 3 or 4 months, which is crazy. And it wasn't even a new build either. It was a phenomenal house, but it wasn't even a new build, and it sold for 45 million. But that was the highest home sale I think out here ever.
That's wild. I remember when the Kardashians bought a house.
And the Madison Club.
Was it in the Madison?
Yeah, there's Chris and Chloe own one, Kylie owns one, and Kim owns one. They all own, not all of them, but 3 of them own houses in the Madison Club.
And they paid $12 million. Courtney paid $12 million for hers.
Mm-hmm. Yeah, everything in the Madison Club, like I think the lowest homes in there sell for $7 million or so.
That's wild. Their HOA fee a month is $1,500.
Yeah, it's wild.
That's funny.
There's
as much as
some
one of my
lots in there that are up for sale for up to 15 million just for the lot.
You think it's because it's like, oh, you're a neighbor with the Kardashians? You think that's what it is?
I think they've just the developers of the Madison Club, they have done this around the U.S. time and time again. They take places that you wouldn't usually like drop that much money, and they somehow create this just crazy community that just people are in love with.
You know that Tim Cook bought a house in the Madison Club too for like $10 million?
Really?
Yeah, like it was a $10 million purchase in the same area.
I know Sylvester Stallone had a house in there. I don't know if he does still.
I think he does because his daughter comes down for Coachella all the time. She's always in town because a couple of the companies out here that I'm friends with that do executive protection have had to protect his daughter because he likes to have security staff.
Wow.
With her at all times. But it's like, man, it's so wild. You know, I remember before I met my wife, I was dating a very wealthy girl, and it was ironic because I was the parents' relationship manager at the time, but I didn't know it was their daughter.
Yeah, that's funny.
So when I started dating
odds?
her, the dad comes into the office and he's all angry or whatever, and I'm like, "What the hell's your problem?" He's like, "You're dating my daughter." I said, "Who's your daughter? What the hell are you talking about?" He's like, "This is her." I was like, "Oh, that's your daughter?"
Did you get it?
No, but I did.
That's funny.
And he's like, "Oh, that's." I was like, "Damn, that's your daughter." I'm like, "Okay, so what's the problem? I'm not a bad guy. Like, the heck? It's obviously not a money thing. I didn't even know it was your daughter."
Yeah.
And I remember when I was hanging out with her one day at her house because she lived at PGA West in the Legends course, and they had a beautiful $1 million home, millions of dollars of a home, and it was gorgeous. It was on like the 17th hole or 16th hole or whatever, and I see Secret Service coming through. Obama bought a house there in that same area. He ended up buying a house in that same part, and I guess they were coming to look at it. I'm not sure if he ended up finalizing it, but it's like,
I know. I think he owns in Thunderbird.
did you see the comment we got?
I did. I was just about to say it. Yeah.
I wonder how much the Kardashians pay for pool service.
I think I had a friend that did was one of the I think he did the pool service for one of them. I don't know what they paid for it though, but I imagine it's a pretty cost.
I'm gonna look that up for you, and that's for those of you who don't know, that's Kevin. Kevin's one of our best clients, favorite fans of the show.
Kevin, you should send them a postcard and say that you could do it better for a better price.
I'm trying to find if there's a number, and I don't really see how much it was.
Kevin, just send a postcard to everyone in the Madison Club and say that you could do it better than their pool man for a better price.
Serious. That's crazy. It's so funny. I wonder how much they pay for the pool service. I would imagine not. I mean, if it's coming from the HOA, $1,500 a month, those are probably huge pools.
I don't know. What does a regular pool service cost? It's a
110 to 150 depending on the
maybe
size
200.
of the pool. Yeah.
Yeah, it's maybe 400 or 500. I don't imagine it jumps up that crazy because I mean their pools are bigger, but it's not like massively bigger. Because I've sold some houses that they have like over 50 foot long, more than 50 foot long pools in some cases, and I still think that was like max 500 for the month.
Oh, we'll see if he gives us an answer here, how much he thinks that would cost. Because Kevin, it's funny, I just met with him today. He had his appointment today, but, you know, Kevin does some pretty decent commercial contracts and nice places, and they pay a pretty chunk of money for their pool services. So I would only imagine if the homes are, you know, $36 million or $10 million or whatever it is, that looks like.
They're paying at least a pretty penny. They're paying some type of pretty penny.
Yeah, no, that's crazy. And then I wonder if they have to sign like a
NDA,
an NDA
I'm
or
sure.
something where it's like you can't say where you know.
I'm sure.
It's interesting. Oh, that's wild. I don't know. It's really it's a good place to be. He said I would do it for free.
Send them a postcard.
He
Send
said,
them a postcard and say, hey, I'd do it for free.
I would do it.
I'll sign an
free for
NDA.
the
I won't speak a
Kardashians.
word.
He just wants pictures. That's all. That's so funny. Well, we're coming up on 50 minutes here. What do you think? Is there anything to add, or we covered the bases?
No, I'd say that's it. I mean, it's just, housing markets, it's slower. It's still moving. I mean, I think there's definitely better deals now. So, like, if you were on the sidelines and you can afford, I would honestly say to buy right now because I think once interest rates, if they do come back down, price is just going to go right back up.
And who should they call if they're trying to buy in the
You
Coachella
should
Valley?
definitely call me.
Give him the info,
Hey,
man.
I'm working 7 days a week, so if you want someone that works hard, I'm here for you.
Give them the info. Tell them who to call. They need to know a number.
You could look me up. My name's Payson Robertson, Peyson, last name Robertson.
Nice, and we'll
we can link it down below.
we'll link it down below just in case anybody wants to. So you're saying it's not the best time to, like, there's no such thing anymore as a good time to buy.
Yeah, but I'm thinking the way I'm seeing it is there's been a 10 to 15% decrease, and a lot of people are on the sidelines right now. So homes aren't moving for as fast. They're not selling for as much, and it's mostly because people are still shocked by interest rates. If you could afford the interest rate and get a good deal on a house, I think it's worth it, and I'm seeing good deals happening now.
Because going back to what I talked about before, and we'll wrap it up here, but stop focusing so heavily on interest, guys. Focus on price, because down the road, interest will change, but what won't change is whether you're over and under on this house.
Of course.
So if the house is only worth $250,000 and you're crazy enough to pay $500,000 for it, well, guess what? Interest could be negative. The bank could want to pay you every month for it, but no bank's going to refinance that deal.
Right.
Which is what caused the 08 issue in the first place. People overextending stated interest or stated income loans, buying things that they couldn't afford, and then overpaying for things that weren't worth what they were worth.
Yeah.
So,
well, that's like real quick. There's a community in Palm Desert right now. It's new builds, and some of them are selling for $440,000 to $480,000. like that I would recommend as like a good deal, because I think in 3 to 5 years in Palm Desert, those homes are probably going to be 650 to 750,000 because of what's going on in Palm Desert and what's being built around that area right now.
Well, if you think about like this Disney project we talked about too, once this thing's done, there's no way that it's gonna be crazy. People are gonna be coming down for all the stuff that man-made lake.
Think about what the Acrisure Arena is already doing to the desert.
Dude, they're bringing in bangers. They brought in Dave Chappelle, Harry Styles, Liz. Like, I was not expecting, and I only like Dave Chappelle on that list I just gave you, but they have been bringing
the type of people that they're bringing in.
I was not expecting them to bring like A-list performers after the other, and it's what it is doing. And you know, when I was at the Dave Chappelle show, he's like, I've never been here before.
That's so crazy.
This man has traveled the U.S. doing comedy. He's like, I've never been in this town before. He's like, I like it. I'll be back.
That's awesome. Yeah, it's bringing so many new people. So I think especially, I think the desert's just prone to so much growth because we're one of the last affordable places in California right now. If you want to be in a
stay out.
Place. Yeah.
Stay out. Let us have this, man. Come on. You already ruined all the places you guys are at. Let us keep ours.
Pay $2 million for a regular house.
You got it?
I got it.
Hey, there we go. Well, the life of that fly ended in exactly 52 minutes and 39 seconds. Well, everybody, thank you for tuning in. Payson, it's always
thank you. It's good to be
always
back.
Good to talk to you, and we'll be back, going back to normal schedule. We'll see you guys on the next one. If you want to pick the topic, feel free to join the MITM membership club, and that's where members get to pick a topic. If you have any questions, feel free to reach out or leave us a comment. Don't forget to like and subscribe. And again, we want to thank USCCA for being a sponsor of the channel. And before we go, we're going to play their outro, and then we'll play our outro, and we'll see you guys on the next one.
Sounds good. See you next week.
It's in our nature to protect the ones we love, to stand up to any danger, to be strong and courageous, to always be prepared, to keep our family safe, to be the first line of defense. We are born to protect.
Thanks for listening to Man in the Middle. If you haven't yet, please consider liking and subscribing to the show. If you can't wait till next episode, follow us on Instagram at MITM Business Consulting and online at mitm.services. There, you can learn more about what we do, how we can help, and the custom services we offer around your personal needs. Until next time, if you'd like to choose the topic we discuss and receive additional services, consider joining our membership program at mitm.services.
Disclaimer. Man in the Middle expressly disclaims any and all liability or responsibility for any direct, indirect, incidental, special, consequential, or other damages arising out of any individual's use of, reference to, reliance on, or inability to use this podcast or the information presented in this podcast.
We look forward to you tuning in next time.